Urban areas are somewhat insulated from Walmart's monopsonic power. In cities with diversified economies and robust transportation networks, workers have more options and employers must compete for talent. For example, in Chicago, Walmart's share of retail employment is too small to dictate wage standards across the city. In contrast, in rural communities like Martinsville, Virginia, Walmart captured more than half of all retail jobs within 3 years of opening, giving it near total control over local wage setting and employment conditions. Walmart's dominance is not static. The dynamics of the labor market are shifting, and the company has had to adapt. In the years following the pandemic, tight labor markets forced Walmart to increase starting wages by 27% in competitive regions. Automation is also reshaping the landscape. Self-checkout systems now handle nearly a third of all transactions, reducing the total number of jobs Walmart offers in each market. While these changes may reduce the company's direct control over local labor markets, they also present new challenges for communities that have relied on Walmart as a major employer. Economic theory suggests that monopsony power is eventually checked by market forces, as workers seek better opportunities or new competitors emerge. Yet, Walmart has proven adept at maintaining its position. When Amazon opened a fulfillment center in Lubbock, Texas, Walmart responded by raising wages just enough to match Amazon's starting rates, without exceeding them. This approach ensures that Walmart remains competitive without driving up wages across the broader labor market. The company's careful calibration of pay and benefits allows it to retain its workforce without fundamentally altering the wage structure in the regions it dominates. The paradox at the heart of Walmart's monopsony power is that it serves as both a suppressor of wages and a promoter of select upward mobility. While the company's practices contribute to lower average earnings and higher poverty rates, it also offers a path to substantial advancement for a small segment of employees. Walmart promotes a significant share of its managers from within, creating highly visible examples of economic mobility. However, these opportunities are limited, and for the vast majority of workers, the prospect of advancement remains distant. The sustainability of this model is increasingly in question. As generational attitudes shift, younger workers express less tolerance for stark pay disparities and are more likely to support unionization efforts. In 2025, unionization attempts at Walmart locations near college towns rose by 38%, reflecting growing discontent with the status quo. At the same time, the company's pricing power continues to attract customers, even as labor market pressures and regulatory scrutiny intensify. Walmart's ability to define the rules of the local economy has far-reaching implications. Its monopsony power shapes not only wages and job opportunities, but also the long-term health of communities, the viability of small businesses, and the burden on public resources. As the landscape of retail employment evolves, the strategies Walmart uses to maintain its dominance will face new tests. The pressures building within this system are setting the stage for changes that could reshape the company's approach to compensation, the future of Walmart's compensation labor relations in the years ahead. Looking ahead, the future of Walmart's compensation strategy will be shaped by a collision of economic pressures, regulatory shifts, and changing workforce expectations. The company stands at a crossroads where its legacy of relentless cost control meets a labor market that is less forgiving of the old playbook. Walmart's ability to maintain its dominance will depend on how it adapts its pay model, balancing the need to attract and retain talent with the imperative to keep prices low and margins stable. Labor shortages are already pushing Walmart to reconsider its approach. With an aging workforce and a shrinking pool of available workers, the company can no longer count on a steady supply of low-wage labor. Nearly 28% of Walmart's managerial staff is set to retire by 2030, and younger workers are increasingly skeptical of retail careers that demand long hours and offer slow advancement. The 44% annual turnover rate among hourly associates is not just a statistic. It represents a persistent drain on productivity and a growing financial burden, as each replacement costs the company thousands in recruitment and training. Walmart's internal promotion system, which has long served as a retention tool, now faces resistance from a generation that expects quicker progress and more transparent career paths. In response, Walmart is experimenting with ways to make its compensation model more appealing without undermining its core philosophy. One area of focus is the creation of more intermediate roles, such as front-end managers who oversee self-checkout operations at salaries around $65,000. These positions provide a bridge between hourly work and store management, offering a clearer path upward for those who want to advance. The company is also testing targeted market premiums, adding pay bumps for managers in high-cost or highly competitive regions. These adjustments are incremental, but signal a willingness to adapt to local labor conditions rather than imposing a one-size-fits-all approach. Pay transparency is another force that is reshaping the landscape. New laws in states like Illinois and Massachusetts now require employers to disclose pay scales and job postings, making wage differentials more visible to current and prospective employees. For Walmart, this means the stark contrast between floor staff and management compensation is no longer hidden. The company's strict hierarchy, once justified by the promise of mobility, now risks fueling resentment as employees see the exact numbers their supervisors earn. Skills-based pay models, where compensation is tied to specific abilities rather than job titles, are gaining traction elsewhere in the industry. Walmart has been slow to embrace this trend, preferring to maintain rigid compensation bands that reinforce its internal structure. Unionization efforts are adding another layer of complexity. While Walmart has historically resisted organized labor, recent years have seen a rise in union activity, especially in markets with younger, more educated employees. Organizers often cite pay disparities and limited advancement opportunities as key grievances. Walmart's response has been to selectively raise starting wages, 27% since 2020, and to invest in anti-union campaigns. These tactics have succeeded in staving off unionization for now, but continued labor tightness and shifting public sentiment could force further concessions. The company's leadership is aware that the threat of unionization is not going away, and that the cost of ignoring worker demands could be higher in the long run than incremental pay increases. Automation is poised to play a central role in Walmart's future compensation calculus. The company has invested heavily in technology across its supply chain, from self-checkout kiosks that now handle nearly a third of all transactions to fully automated distribution centers where robotic arms and driverless forklifts handle physically demanding work. Each new automated facility is projected to save $90 million annually, a figure that underscores the scale of Walmart's cost-cutting potential. These savings create an opportunity to fund higher wages, but the company's track record suggests that price reductions and margin preservation will remain the top priorities. When Walmart raised wages in 2015, its stock dropped 10% after investors learned of the near-term profit impact, a lesson that continues to shape executive decision-making. The shift towards automation also changes the profile of the workforce Walmart needs. As repetitive tasks are handed off to machines, the company must hire and retain higher-skilled technicians to maintain and operate new systems. These roles command higher pay, often $25 an hour or more in automated distribution centers, nearly double the typical wage for warehouse workers. This evolution creates upward pressure on average pay, even as the total number of jobs may decline. Walmart's challenge will be to integrate these new roles without disrupting its finely tuned cost structure. Ethical scrutiny of Walmart's pay hierarchy is intensifying. The company's decision to pay market managers up to $620,000 a year stands in sharp contrast to the reality faced by hundreds of thousands of employees who qualify for Medicaid or other public assistance. CEO John Furner has defended the practice, arguing that high compensation for managers makes them feel like owners and drives performance. Labor advocates, however, view this as a symptom of a broken model that rewards a select few while leaving many behind. Public sentiment is shifting, with more Americans questioning whether such disparities are a necessary feature of modern business or a failure of corporate governance. Investor expectations remain a powerful constraint on Walmart's compensation strategy. The company trades at a fraction of the sales multiples enjoyed by tech giants like Amazon, a reflection of Wall Street's skepticism about retail's growth prospects. Any move to raise wages is scrutinized for its impact on margins, and history shows that investors are quick to punish deviations from cost discipline. Walmart's $5.8 billion in annual share buybacks signals to shareholders that management remains focused on delivering returns, even as it navigates the complexities of a changing labor market. The company's leadership knows that any significant shift in compensation policy must be offset by gains in efficiency, new revenue streams, or other cost reductions. Regulatory changes are also on the horizon. States are beginning to experiment with laws that require large employers to meet higher wage floors or to assess the labor impact of new store openings. While Walmart has managed to secure exemptions in some rural areas, the trend is clear. Policymakers are more willing than ever to challenge the traditional retail labor model. The company is preparing for this new environment by diversifying its revenue base, investing in advertising, membership programs, and data sales to help cushion the impact of potential increases in labor costs. These efforts are not a substitute for structural change, but they provide a buffer as Walmart adapts to a more demanding regulatory climate. The future of Walmart's compensation model will be shaped by 5 key trends. First, tightening labor markets mean that the company can no longer rely on a surplus of workers willing to accept low wages. As the population ages and participation rates fall, Walmart will have to offer more competitive pay to attract and retain talent, particularly for demanding management roles. Second, the rise of automation will continue to displace low-skill jobs while creating demand for higher-paid technical positions. This shift will require a rethinking of the company's approach to training, recruitment, and pay scales. Third, generational shifts in worker expectations, especially among millennials and Gen Z, will put pressure on Walmart to offer more flexible schedules, quicker advancement, and a better work-life balance. Fourth, increasing demands for pay transparency will make it harder to justify extreme disparities, forcing the company to reconsider how it communicates and structures its compensation packages. Finally, investor pressure for margin preservation will continue to limit how far Walmart can go in raising wages without offsetting those costs elsewhere. To address these challenges, Walmart is making a series of targeted adjustments. The company has introduced new management roles focused on overseeing self-checkout and e-commerce operations, providing stepping stones for ambitious employees. In high-cost markets, it offers premium pay to compete with rivals like Amazon and Target. Stock grants for market managers have been expanded, allowing the company to align interests without committing to permanent base pay increases. These moves are designed to preserve the core logic of Walmart's compensation system, rewarding those who deliver results, while making incremental improvements that address emerging pressures. Walmart is also exploring new models of employee motivation. In select stores, the company has piloted gain-sharing programs, where entire teams receive bonuses based on operational improvements. This approach seeks to address the morale issues that arise when individual manager bonuses are funded by cost-cutting measures that affect the broader workforce. Another experiment gives department managers small equity stakes tied to the performance of their sections, creating a sense of ownership without the complexity of full profit sharing. These initiatives are in their early stages, but they reflect a recognition that the old model may not be enough to sustain engagement and productivity in the years ahead. Economic volatility could accelerate changes to Walmart's pay strategy. The company's resilience during the 2023 inflation spike, when it gained market share as consumers traded down, demonstrates its ability to weather shocks. Because Walmart's margins are so thin, even small increases in efficiency can fund selective wage hikes. Analysis shows that a $1 per hour increase for all hourly employees would reduce annual profits by about 8%, a manageable hit compared to what competitors would face. This flexibility allows Walmart to evolve its compensation model incrementally, rather than resorting to disruptive overhauls. Union activity remains a wild card. Labor organizers have shifted tactics, drawing comparisons between Walmart and competitors like Costco, which pays hourly workers significantly more while maintaining strong profitability. Walmart counters by pointing to its vast scale and the complexities of managing compensation across thousands of stores. Still, the pressure is mounting, and the company may eventually be forced to make broader concessions to avoid the risk of widespread unionization. Walmart's international operations offer another lever. In markets like Mexico and India, the company operates at higher margins and adapts its pay structures to local conditions. This flexibility could inform future strategies in the U.S., allowing Walmart to segment compensation by region or market type. However, the rise of pay transparency laws complicates efforts to maintain different pay scales in different locations, as employees and the public gain access to more detailed compensation data. Ultimately, investors will continue to set the boundaries for what is possible. Walmart's $760 billion market cap depends on maintaining operating margins within a narrow range, and any changes to compensation must fit within this framework. This is why the company's leadership emphasizes technology and process optimization as the primary means of funding pay increases. When Walmart last raised wages in 2015, the 10% drop in its stock price made clear that shareholder priorities remain at the forefront of decision-making. The company's scale remains its greatest asset. With thousands of stores processing millions of transactions each week, even minor improvements in efficiency can generate the savings needed to support selective pay increases. Training cashiers to scan items slightly faster or reducing inventory discrepancies by a fraction of a percent can translate into hundreds of millions in annual savings. These micro-optimizations form the backbone of Walmart's compensation strategy, allowing it to reward high performers while maintaining its commitment to low prices. At its core, Walmart's pay model is engineered to keep employees striving for advancement, even if only a small fraction make it to the top. The visibility of high manager salaries serves as both a motivator and a justification for the system as a whole. As long as workers believe in the possibility of upward mobility, and as long as operational gains can fund selective rewards, Walmart's model is likely to endure. The debate over its ethics and sustainability will continue, but the underlying mechanics remain clear: efficiency, scale, and relentless focus on cost control. This approach, built on extracting the maximum value from every role, sets the stage for the company's ongoing success, and for the difficult questions that come with it. Walmart's model stands on a paradox. It can pay top managers extraordinary salaries only by driving relentless efficiency throughout the organization. The company's commitment to everyday low prices is made possible by a system that relies on micro-optimizations, strict cost control, and an uncompromising focus on margins. Every layer of the business, from logistics to staffing, is engineered to extract savings wherever possible, allowing Walmart to offer prices 10 to 25% below competitors and still reward its highest performers. This approach has delivered clear benefits to consumers, particularly low-income families, but it also raises questions about whether such a model can be replicated or sustained without inheriting its contradictions. As Walmart faces new pressures from technology, labor markets, and public scrutiny, its future will depend on how well it can adapt its core strategy while maintaining the balance between efficiency and opportunity.